Hello, welcome to part 2 of the Technical Accounting Update. I'm Janice Parthen, and today I will be highlighting key topics discussed from the AICPA and CIMA Conference of 2021. To provide background, I'm Janice Parthen, VP within RGP's Advisory and Project Services team. I lead a number of cross-functional initiatives within finance, accounting, and risk and compliance. My background is in finance and technology process design, risk management, and driving continuous improvement for clients. RGP is a global consulting company serving over 2,400 clients, which includes 3/4 of the Fortune 500. RGP enables rapid business outcomes by bringing together the right people who then together drives transformative change. Now, I'd like to share a disclaimer. The views expressed in this presentation are those of mine and does not necessarily reflect the view of others. These slides are for educational purposes only, and they are not intended to be relied upon for accounting, tax, or other professional advice. Today's agenda will be covering the 2021 AICPA and CIMA Conference, providing some background, and then highlighting the key topics from that event. To provide background, this has been a national conference that has started in the 1970s. This is an annual conference where key stakeholders gather to provide updates on the latest accounting and reporting issues pertaining to SEC registrants and auditors. This session also highlights the conference topics that were discussed in December 2021, but I want to emphasize that this presentation is not all-inclusive and it only represents highlights. The first area I'd like to be able to discuss is in terms of accounting consultation topics with the SEC's OCA. Two key topics that had continued to come up were revenue recognition and shared-based payment awards. Digital assets and SPACs were also a relevant topic, but I will cover that later in the slides. Now, in terms of revenue recognition, in Paul Munter's speech, he discussed how revenue consultations with the OCA often relate to the identification of the company's performance obligations, including principal versus agent analysis, identification of the company's customers, and accounting for consideration payable to the customer. For principal versus agent, it can be more challenging to determine in certain industries, such as digital advertising or technology, where arrangements often include multiple parties providing the good or service, or essentially the good or services are integrated. To determine whether a company represents a principal or an agent, judgment is required to understand the nature of the contract. This includes identifying the specified goods or services to be provided to the customer and assessing whether the entity controls each specified good or service prior to the transfer to the customer. It's important to reach the proper conclusion since a principal records revenue on a gross basis and an agent records the revenue on a net basis. Now, for consideration payable to a customer, an entity shall account for consideration payable to a customer as a reduction of the transaction price or revenue, unless payment to the customer is in exchange for a distinct good or service. Significant judgment is needed around understanding the nature of the obligation to understand whether to account as a reduction or expense, and having to appropriately identify the customers. Examples such as do the entity's customers, or essentially the end users need to be considered. Now, moving over to shared-based payment awards, this has been a popular topic as this activity impacts a company's stock price. To explain further, spring-loaded awards are share-based compensation arrangements where a company grants stock options or other awards shortly before it announces market-moving information such as the earnings release with better than expected results, or the disclosure of a significant transaction. The SEC's DCF recommends that companies measure compensation actually paid to the executive. They must consider the impact that the material non-public information will have upon release. SAB 120 provides additional guidance on estimating the fair value of the share-based payment transactions, which includes determination of the current price of the underlying share and the estimation of the expected volatility on the price, as well as the accounting disclosure. The guidance suggests that companies should consider whether adjustments to the current price of the underlying share or the expected volatility of the price of the underlying share for the expected term of the share-based payment award are appropriate when applying a fair value-based measurement method, and to estimate the cost of its share-based payment transactions. Now, let's not forget internal controls. It's important to have controls in place, especially for non-routine grants. And for additional resources or guidance, you can refer to ASC 718 or SAB 120 as well. Next, I'd like to provide a summary of key topics mentioned from the SEC's DCF, or the Division of Corporate Finance. The DCF shared some key themes around non-GAAP disclosures that consistently raised concerns. One is the prominence of non-GAAP measures. In SEC's Compliance and Disclosure Interpretations, non-GAAP financial measures, question 102.10, when a registrant presents a non-GAAP measure, it must present the most directly comparable GAAP measure with equal or greater prominence. The key point is that GAAP is the foundation and should be the focus. Mislabeling of measures is the second item. One example shared was the labeling of contribution margin in place of gross margin. Third was performance metrics. If metrics are included, disclosures should also be included, such as having clear definition of the metric and how it is calculated, statement indicating the reasons why the metric provides useful information to investors, and statement indicating how the management uses the metric in managing or monitoring the performance of the business. The SEC's DCF communicated the importance of being consistent on how metrics are calculated, as well as maintaining proper controls and procedures. The Commission also provided additional guidance on this topic as well. In terms of a segment report, DCF communicated common themes that raised concerns. Common themes, one, included identification of operating segments, as the operating segment should be tied to the entity's decision makers' use of the financial information to make decisions about operating matters. DCF indicated that staff are likely to comment when an entity only has one reportable segment when there are changes in the business structure that was shared publicly and that suggests otherwise. Aggregation of operating segments. Criteria and quantitative threshold defined from ASC 280 needs to be considered to determine whether to aggregate operating segments into reportable segments presented. Third item was measurement. Entities should be consistent when reporting segment P&L measures if there are multiple segments included. SEC had raised concerns when companies are presenting multiple measures for the multiple segments reported. DCF has also been providing feedback on requiring enhanced disclosures on entity-wide information. Now, if there's a change in reportable segment, DCF noted that it's important to include a revised segment disclosure, segment footnote, if the reportable segments change. You can also refer to SEC's Financial Reporting Manual, topic 13310.1. SEC staff considers all publicly available information when reviewing a registrant's filing, such as earnings calls, website, industry, or analyst presentations. And then lastly, there is likelihood that FASB will propose an update on disclosures for significant segment expense categories and amounts. So stay tuned this year. Now, the next topic, materiality of misstatements. This topic came up multiple times as well at the conference. To provide background, Big R is to restate and reissue prior period financial statements and inform users that the financials are restated. Little r is to correct the error in the current period financial statements or adjust the prior period data and disclose the year all within the current period financial statements. With recent trend, Paul Munter, acting chief accountant for the SEC, discussed how recent trends indicate that companies are approaching restatements as little r's. The SEC emphasized the importance to evaluate and evaluating in terms of the total mix of information, essentially quantitative and qualitative, not just based on a percentage threshold. The other point was the magnitude of the error, the probability that the judgment of a reasonable person relying upon the report would have changed or influenced. Last, it's also important to evaluate ICFR and control deficiencies related to the errors, whether it creates a deficiency or a material weakness. For additional reference, please refer to SAB 99 or topic 1M. The next topic, ESG reporting. In terms of ESG reporting, which stands for Environmental, Social, and Governance, from SEC's OCA's perspective, the ESG priorities include human capital, board diversity, and cybersecurity risks. There's also a large percentage of public companies who have ESG reporting but are not consistent in reporting. Lastly, the SEC has requested for comment for climate disclosure in terms of through late 2021. So stay tuned as more developments will occur this year. In terms of SEC developments from 2021 last year, in terms of amendments to the Regulation SK, at least the latest one that was effective for 2021, the description of business include having to require human capital disclosure. Also, the SEC has created an enforcement task force to monitor climate and ESG reporting, 22 members. Also, the SEC had issued a risk alert having to report on observations of deficiencies and internal control from examinations of investment advisors and funds regarding ESG investing. Lastly, in terms of other considerations, SEC also reminded entities that disclosures in business or MD&A are subject to disclosure controls and procedures, DCPs, and that includes ESG information. Also, just wanted to mention the formation of ISSB. ISSB stands for International Sustainability Standards Board, and it was created in November 2021. But the board will take time to establish. First, they will need to be able to establish the board members to be seated. Next, I'd like to highlight the topic of IPOs and SPACs. In OCA consultations, the top issues identified were accounting for warrants pertaining to IPOs and SPACs, or more so SPACs. In May 2021, over 3/4 of restatements of past financials were SPACs, according to audit analytics, and significantly triggered by warrants. ASC 815-40 provides guidance to evaluate accounting for contract warrants by indexation and equity classification criteria. Warrants that do not meet the indexation guidance or the equity classification guidance will lead to a liability classification. Fair value input is also relevant in the analysis, and as specified in the standard, In unique scenarios, entities should consider other variables for evaluation. The DCF also emphasized the importance of disclosure on financial incentives of the SPAC sponsor to complete the transaction, including potential conflicts of interest and the risk to shareholders who continue to hold shares after the SPAC merges. The other topic is the instrument to redeem, or temporary equity, was also an area of concern. Redeemable either early or after a merger, shares to redeem early were recommended to be classified as temporary equity. Redeemable equity feature for cash that is outside the control of the company should also be classified as temporary, according to the SEC, as it will occur either when combined or dissolved in itself. SEC noted that there were a number of companies that classified these as permanent equity when it should have been temporary. Also, just wanted to highlight in terms of the Division of Enforcement, who conduct investigations into possible violations of the federal security laws and prosecutes SEC's civil suits in the federal courts. They are also involved in a number of cases that has pertained to SPACs. Now, in terms of digital assets, as mentioned earlier in the FASB developments in part 1 of the presentation, FASB had issued an invitation to comment starting in June 2021. From the comments received, there were significant interest in digital assets, and actually number 1, based on public comment received to date. From SEC perspective, digital assets should be accounted for as intangible assets under ASC 350. The OCA consultation questions also received mostly regarded approach in general, as well as the remeasure of carrying value. The AICPA issued a practice aid that is in a format of Q&A. At a highlight, according to ASC 350, entities should determine the useful life of an intangible asset and initially be measured at cost. If it is a contract with a customer for a digital asset, according to ASC 606, receipt should be treated in form of a non-cash consideration at fair value or selling price. But there are other considerations that may occur to require further evaluation of the asset in question. If the asset is to be remeasured for impairment, you'll want to take into consideration FASB ASC 820 fair value measurement. I also suggest stay tuned based on FASB's research agenda for 2022 to include accounting for exchange-traded digital assets and commodities. The research project will explore accounting for and disclosure of a subset of exchange-traded digital assets and exchange-traded commodities. On international matters, we have the Holding Foreign Companies Accountable Act, HFCAA. This applies to registrants that SEC identifies as having filed an annual report with an audit report issued by a registered public accounting firm that is located in a foreign jurisdiction and that the PCAOB is unable to inspect or investigate, as these are commission-identified issuers. In December 2021, SEC adopted the amendments to finalize the rules to include submission and disclosure requirements mandated. And if true for the issuer, the entity must establish that it is not owned or controlled by a government entity in the public accounting firm's foreign jurisdiction. The SEC has also established procedures to identify issuers and to impose trade prohibitions as required. 2021 will be the first reporting year to be considered. For the London Interbank Offered Rate, or LIBOR, is an indicative measure of the average interest rate at which major global banks can borrow from one another, or a reference rate. This has a larger impact to financial services organizations, but there are still some impact throughout other organizations. Publication of certain maturity categories have ceased immediately after December 31, 2021, with remaining to cease after June 30, 2023. Companies are considering an alternative, such as Secured Overnight Financing Rate, or SOFR, to replace. From a panel discussion with chief accounting officers at the AICPA and CIMA Conference, Libra transactions are flagged for assessment to transition for SOFR in terms of how they had handled the change. And with cloud-based platforms, there may be functions that be able to help address, but this is depending on the ERP system. Lastly, ISSB, as mentioned earlier, the International Sustainability Standards Board, this was created in November 2021, but it will take some time to establish. Now, this concludes the presentation on key topics, and thank you for your time.